Welcome to the September edition of the Cerini Nonprofit Connection. Today, we are extremely pleased to have with us as our guests Ken Jones and John Beres from SterlingRisk Management to discuss organizational risk and how to mitigate it within the nonprofit sector. Welcome, guys.
Thanks for having us.
Thank you.
No problem. Ken and John, maybe we can first start off by if you can explain a little bit about what SterlingRisk does for the nonprofit sector, that would be great.
Sure. It's important to keep in mind, at least us as insurance brokers, that most nonprofits work on very tight shoestring budgets. And our firm works not only with finding the best carriers, coverages, and terms and conditions. The critical piece is to properly manage the risk of the nonprofit. You got to make sure that someone is monitoring their claim activity, making sure claims are moved to closure, also making sure that exposures are lined up with the coverages. An uncovered loss within the nonprofit sector could potentially cripple an organization and could possibly put the board members in a very tenuous position. We have our own in-house loss control, claims counsel, and et cetera, that enables us to properly act as the nonprofit's outsourced risk manager. So you need to make sure that if there is a potential loss, that they will have a policy in their hands that will respond.
Okay, so you brought up a couple points there. You brought up risk to directors and officers. You brought up the need to really understand what your risks are and everything. Let's start with maybe the board piece. So what can board members do to mitigate risk? I know there's directors and officers insurance that's out there. You want to talk a little bit about D&O coverage and maybe some of the typical gaps you see in some of the policies that are out there that kind of expose the board?
Sure. From the basic construct of a directors and officers liability policy is really threefold. It's to protect the individual directors and officers that are serving as board members for the not-for-profit.
Okay.
It is to protect the organization itself if it is sued for the corporate activities and corporate governance, as well as it protects the not-for-profits, I'll say piggy bank or war chest, because in the case that they have to indemnify a director and officer, instead of looking to their own funds, they would look to a directors and officers liability policy to protect the directors and officers or to reimburse them based on the bylaws and the corporate governance that they're required to indemnify the directors for their acts on behalf of the organization. More importantly, with the directors and officers liability policy, it also provides the organization with coverage for employment practices liability, which historically what we see in a claims perspective, it is suits from your employees that are probably the largest driver of claims against not-for-profits.
Okay, and that covers the agency and the board members?
Correct, and employees. So the manager that may be alleged to have either wrongfully terminated an individual, sexual harassment, failure to promote, failure to hire. So not only is it covering the board members, it's covering the corporation as well as the employees of the not-for-profit.
Okay, so where do you typically see policies kind of fall flat, and where maybe there's other coverages that are needed, or where there are provisions that are not being necessarily written the way they should be?
Right. So the uniqueness of the insurance industry as a whole is that you take an off-the-shelf product that has a shell of coverages, and then to Ken's point earlier, what a good insurance broker is going to do then is tailor the policy to make sure it's protecting the board for the risks that it actually has at hand.
Okay.
And a board could potentially have different risks if you are in the education space, the healthcare space, funding. All of those bring a host of different exposures that are not generic to all boards, but you as a broker need to understand what is it that the organization is actually doing to make sure it's properly covered, and you're tailoring the coverages to adequately protect the board.
Okay, so when you come in and you're talking to a board and or talking to an organization about D&O coverage, what are you looking at? What are you looking for? Where do you typically find errors or mistakes that organizations are making?
So that's a great question. And there are several answers to that. I think the biggest exposure that we see that is not being properly addressed these days is it's wage and hour, so that if you have workers that are on hourly that are non-exempt or that are not exempt and you're not properly paying them, there could be a claim against the board and the corporation for a wage and hour claim. What we also see is third-party employment practices claim. You choose not to work with a vendor and a claim comes in that you discriminated against me for whatever reason. If a D&O policy is structured properly, it will pick up claims from third parties, not just your employees that are bringing a claim against the board. So
not every policy does that?
Not every policy will do that often. So you need to make sure that you're actually understanding what the exposures are and then tailoring the risk or the policy coverages to make sure that you're adequately protecting that board.
Okay. And to John's point, talking about nonprofits that work in the healthcare field, one of the things that we're seeing a lot of claims today, and sometimes the policies don't fully address it, is the employment practices liability, that it would include sexual assault and molestation, which is a key coverage that we see missing on a lot of home healthcare operations.
What about things like HIPAA compliance and stuff like that? Are there provisions within that covers HIPAA type issues, or no? That's kind of separate.
Typically that would be separate, but what you do look for is coverage that will at least give the board a protection of the defense of a claim, so that if there's an allegation, and this gets into the nuances of the language of the policy, it may not cover you for the actual HIPAA violation, but it will cover you for the defense of the costs of the claim that's made against the board. So because as a board member, presumably a board member would take the position that I'm not in the weeds at the HIPAA level, I have an HR department, but the board is going to get sued. Similar to Ken's point on a abuse and molestation claim from a social service agency that is dealing with children. The board's going to say, wait, we did a background check. The employee has no criminal record. They were hired properly. A bad claim came in. How am I liable? And the answer is you may not be liable, but you're going to get sued anyway. And you want the D&O policy to at least respond to the defense of the board for a potential breach of their fiduciary responsibility. How a lawyer can prove that there was a breach of their fiduciary responsibility is truly a legal question, but you want to at least know that the D&O policy, if constructed properly, will provide that at least a moniker of defense to the board. Because what we see now, typically a D&O claim comes in, no matter how frivolous it is, easily the legal expenses are going to run up to 6 figures just to get out of the matter.
Right.
And for most nonprofits,
that's a lot
of money.
Recent surveys showed the average cost of defense of a case. I think it was a Wyatt survey, which does surveys for nonprofits, that the average cost of defense is between $45,000 and $100,000.
Wow. And
the average payout or indemnification under the policies is about $460,000. So it's
big numbers.
Big numbers.
And one of the other things we'll do is we look at, and any broker should do this, because one of the questions we're always faced with is how much limit should we buy? There's many benchmarking tools that are available to us as a broker and multiple brokers, both looking at our own empirical data that we have of our existing client base, but as well as databases that we have access to benchmark what an appropriate limit of liability would be for an organization, depending on its size, whether it's what their the number of employees they have, what their assets are, to give a client a range of, if you fall into this category, you should have somewhere between $1 million and $1 million and $2 million if you're this size, so that they are making an educated decision, because remembering that the limit of coverage you're buying is for your entire board. It's not per director or officer. So if you're buying $1 million of coverage and you have a 10-person board and they're all sued, it's not a lot of limit.
That's right. Okay. So this is basically a rule of thumb in terms of how much each.
Correct. It's a rule of thumb, and ultimately it comes down to what the cost is.
That's right. One of the things that we've seen a lot when we've gone in and looked at different nonprofit organizations and looked at their governing documents, it's oftentimes that organizations have mission creep. So when you have this mission creep that's taking place, you could have a certificate of incorporation that says this is what you do as an organization. And then you start doing other things too that may not find their way into the certificate of incorporation, which then means that the nonprofit organization may be operating not in compliance with its organizational document. How does that impact D&O coverage, and what should organizations be looking at or doing?
So part of the underwriting process for any either new account being written or looked at from an underwriter or a renewal, and we as the broker, we always ask for the articles of incorporation and the bylaws, just so we have an understanding of what is it that what is the mission of the organization, and then we look at the application that's been completed to make sure that they're aligned with one another. When they're not, we'll ask questions. From a exclusionary perspective on an insurance policy, though, it would be unlikely that a carrier would raise the question that your mission is not clearly defined in your governing documents. It's really a matter of, are you breaching your fiduciary responsibility to either your stakeholders and or your constituents that you're serving by having mission creep. But absent of a breach of that fiduciary responsibility, it's my opinion that there would be no red flag for a carrier to potentially deny a claim that comes out of that.
Okay, so there's really, because I've talked to attorneys and they said then that there could be some exposure there. So I just wanted to find out for sure.
I don't believe there would be. I mean, every claim stands on its own merit, but that being said, I think that what's more important was it a true misrepresentation, or has it just been a change of course that hasn't, and what are the unintended consequences of that change? What I have seen, and have been claims talking about potential claim exposures that have occurred, is you have an organization that is raising money, saying that we're raising money for X cause, and then we decide to redirect those funds to another cause, and then your donor base will turn around and say, well, I gave the organization, I donated to the organization thinking that this is what you're funding, and now I'm hearing you've whether or not that's mission creep or not, but now you're funding a different avenue with the funds that I gave you that I thought were being directed here. There, potentially, you have a breach of fiduciary responsibility, which, again, depending on how the articles of incorporation are written, whether or not the organization has a contractual obligation to indemnify those directors and officers that have made that decision. And that's where I think it's important to look at those on an annual basis.
Okay, Ken, you mentioned earlier that you talked about the board issues. You also talked about some of the risks that are out there, and part of the goal is to ensure that when you come in and you look at an organization, that you're a good broker should be in there looking and trying to find ways to mitigate risk and everything else. Can you talk about some of the war stories that you've run across, and maybe some of the places where you've helped an organization so that people kind of start thinking a little differently?
Well, actually, that's a good point. And actually, I was just talking about it with our in-house coverage counsel, talking about war stories. There's a very topical story right now that's all over the newspapers, is Antonio Brown.
Mm-hmm.
How does Antonio Brown fit into this conversation? Well, Antonio Brown, as you know, is a player for the...
He's not a nonprofit?
He's not a nonprofit. He's a football player for the now New England Patriots.
Yep.
And he went to a not-for-profit fundraiser. And at this fundraiser, they were selling artwork. And he saw a particular piece that he liked, and he bought it and took it home with him. Didn't pay for it, but he still in question whether or not he's paid for it yet. But
bought it. Okay.
He took it home with him.
Bought it.
But he really liked the piece, and he liked the artist. So he was actually introduced to the artist at the event, and he asked the artist to come to his house and commission the artist to do a mural in his house of him. And it was this artist that is now embroiled in this civil suit against Antonio Brown because he's allegedly sexually molested her while she was performing this job of doing a mural at his house.
Okay.
So we were talking about it with the coverage council, and how would the nonprofit be? Well, the nonprofit was, he met the woman at the nonprofit, and it's a civil suit. It's not a criminal suit. So in a civil suit, they bring in everybody. So here you have a case where the nonprofit has very little issues, but they didn't really do anything wrong, but they're going to be brought in. They're probably most likely going to be brought into this civil suit to have to defend themselves because it originated from their event.
So no good deed goes unpunished.
No good deed goes unpunished. I know, John, you have a few other that you've been personally involved in.
Right. So, other war stories that I've experienced, and they're very broad ranging. One was actually multiple ones, both in the education space, but also in for religious institution, is that the boards were sued personally for failure to oversee either the head of school or the head, in this case it was a synagogue, over alleged sexual harassment. And one was sexual harassment, the other was potentially allegations of inappropriate conduct with minors. And the boards were named in the suit for their failure, their breach of fiduciary or breach of duty to the organization. So, that's something that's very relevant today that we're seeing from a lot of
the whole Me Too and everything.
Correct. Other areas of claims that we've seen is that one of a charitable organization sold the building that they felt was it was the right time to sell it, and some of the stakeholders in the organization, so donors, felt that they didn't get a fair price for it. So they brought a suit against the organization saying you didn't really do your proper due diligence when you sold the building. There was any self-dealing. It wasn't they were working with a preferred real estate broker. It was an opinion that they didn't get the best price for the asset. So again, frivolous or not, the organization feels like the board feels they're acting in the best interest of the organization, and somebody disagrees with it.
So are these all things that would be covered under D&O, or these things that would need special provisions?
They wouldn't need special provisions, and they would be provided with a defense of the claim. And if it is then proven, the allegations are proven that there was a nefarious act or something there was a misdeed, the D&O policy would respond. Again, it goes back to what we mentioned earlier, is just the defense cost of these claims can run up, hundreds of, thousands of dollars in a very short period of time. The nice thing about directors and officers liability policies, especially in New York State, the deductibles are very low in general for the $1 million to $2-3 million policies. Deductibles traditionally are only $1,000 to $5,000 maximum. So the out-of-pocket that the organization is going to have is not a huge amount.
Okay, so that kind of brings up two questions, what you talked about. Let's go to the low-hanging fruit in terms of what you said. So, you talk about that the policies have low deductibles. Does it make sense for organizations to try in some of these insurances to bump the deductibles up so that they can buy more top-side coverage? Because I know most organizations can absorb a $10,000 or $20,000 risk, but they can't absorb a $10 million risk. So, does that make sense, and kind of how does that work?
Yeah, it certainly does. Depending on the organization's cash flow and the ability to absorb a $20,000 or $30,000 legal bill, we would traditionally always look to recommend that you look to buy the catastrophic coverage and not worry about trading dollars on a small claim, because those small claims, if they add up in the best case scenario, an employment practices claim, if you have a claim, it could easily, between legal expenses and possibly settling with the former employee, you'll run up $35,000, $40,000, $50,000 of expenses. If you had, and then at your next renewal, your insurance company is going to look for more premium from you because of the claim experience, versus, as you're saying, if you're eliminating those claims, self-funding those, that premium, those dollars could easily be used towards buying higher limits of coverage. Absolutely.
Okay. The other question is, we've been talking about D&O policies. If a board puts in place a D&O policy, does that really mitigate all risk for board members, or what other risks might still exist for those board members?
Well, it mitigates many of the risks. And the most obvious is fraud and dishonesty is never covered.
Okay.
For the individual. That, I'll break the board into the black hats and the white hats. If you are actually the individual that caused or perpetrated a dishonest or fraudulent act, you're never going to have coverage. The innocent directors and officers will always be protected.
Okay.
I think the biggest issue that we run into, though, is a limits question, going back to your earlier comment about, are you better off buying more catastrophic coverage? Because at the end of the day, if the organization doesn't have the financial wherewithal to either indemnify or doesn't have the cash, you as a director in the state, in New York State, and I think for almost all states, have financial responsibility then, and you can be held personally liable for that. So it is important to recognize, as a board member, you do have personal exposure, and that is why most board members always ask, does the organization maintain directors and officers coverage? But to some extent, you should be mindful of how much do you actually have, if there's ever a concern that the organization doesn't have the wherewithal to reimburse you for the costs.
Okay. Okay, so moving off D&O now, what other coverages should nonprofit organizations be looking at to decrease their overall risk?
I think what we're seeing, and hardly a day goes by, is cybersecurity and privacy liability coverage is probably the most widely talked about these days, because hardly, as I said, hardly a day goes by that whether it's a large corporation is not being hacked, but even small, not-for-profits or not-for-profits in general are exposed. And despite the best IT resources that you have, typically most breaches are occurring by human error. Somebody's clicking on a link that they shouldn't have clicked on, and somebody was doing a phishing or social engineering claim that comes up, and it's the innocent act that then breaches or allows a breach into your organization's servers. Mm-hmm. So what we're seeing is an uptick in many organizations asking us about cybersecurity coverage. What's nice about it from our perspective is, despite the rash of claims that are out there, it is a very affordable coverage today. There are multiple insurers that are writing it, and writing it well, in our opinion, providing the breadth of coverages that most organizations should have at really not a very expensive cost. And each risk certainly is underwritten on its own merits. But it is something that I would strongly recommend. I know Ken and I talked about this earlier, that every organization should at least talk to their broker about, to understand what the costs are, what is it actually covering me for, and should I have it?
Usually the basic policies or package policies that they have addresses cyber coverage, but it is so minuscule as far as the breadth of coverage that it would need to be a standalone cybersecurity policy. And one of my favorite lines was when I on cybersecurity was, the director of the FBI clearly just said, it's not a matter of if, it's a matter of when. Everybody is going to be affected by cybercrime at some point or another, and it's a very real. You're taking donors' information, you're getting donors' credit cards, and it just takes one wrong click and that information is out there in cyber world, and the cost of credit checks and things like that it could cripple an organization without the cyber coverage.
Okay. What other coverages?
Again, depending on the nature of the not-for-profit and what they're doing. So if you have if you're a social service agency, you're going to have, at the outset, you're going to have a general liability policy, which is covering you for claims from third parties for bodily injury or property damage. You're going to have a property policy covering your physical assets that you own. You might have an automobile policy, or what's called a non-owned automobile policy, that covers you for covers the organization in the event that a volunteer is driving a car for something that you're utilizing, that they're doing on your behalf, and a claim comes in naming you.
So let's stop on that one a second. And I think that might be a place where nonprofits aren't necessarily thinking about the coverage. So you're talking about having a policy where if an employee is traveling for the organization or a volunteer is traveling for the organization, so an organization could have no cars, but just the fact that there's a lot of traveling that takes place for that organization, they really should have a policy to cover.
Correct. And it's specifically called the non-owned and hired car policy. It doesn't cover the individual that's so either the volunteer or the employee per se. It's covering the corporation that if they are sued because of the act of the driver, it protects the organization. Presumably, if you have your own personal automobile policy, that policy is going to protect you in the event that you are driving your car, but the organization is not covered by your personal automobile policy. This non-owned hired car policy would do that.
No, and just one other piece, the thing you were talking about before, as far as a board member who's embezzling or steering funds away from the organization, that would be a crime policy. The D&O policy would address the coverage for the directors who did nothing wrong. But as far as, now the organization has, somebody's embezzled, $100,000, if they had a crime policy, that would address and reimburse the organization for that loss.
Okay. And then in terms of, a lot of organizations have fundraising events and stuff like that. I'm assuming that if they have a fundraising event, it's an off-site fundraising event, they need to have some sort of coverage to cover.
Correct. So many general liability policies that the organization will buy will either allow you to schedule a fundraising event off-site. If not, there are multiple carriers that provide single event coverage, and there's two schools of thought on that. You may be better off buying a single event policy for a very nominal cost. It isolates what I call your standing general liability policy from claims, because when you have that event, you potentially have a heightened exposure. So, and if something was to happen, why pollute your annual policy that renews with a claim that could have been carved out? So there are two schools of thoughts as to what's the best way to buy that policy. Some of our not-for-profits who hold multiple events through the year would rather have it as part of their, what I call their practice policy or their annual policy, versus a single off one event policy.
But those are the types of things that a good broker should be able to look at and
Absolutely.
determine what's the best course of action.
Correct. And the broker should be able to advise you what's the best course of action. And then more importantly, the venue location is going to come to the not-for-profit. Okay, you've signed the contract with us. Here are our insurance requirements. We're expecting you to bring this amount of coverage and indemnify and hold harmless the venue for certain liabilities. However, a good broker should also look at that contract to make sure, wait a second, I'm not responsible if something spills on the floor. That's the venue. I don't want to be held responsible for that, and make sure that that contract's written properly, which I know Ken's about to chime in and say that's really what one of the value adds that we bring with our counsel that is in-house, to look at all of those contracts to make sure there is proper risk transfer where appropriate.
Ken, is that what you're going to say?
That was exactly what I was going to say. You stole my thunder. Yes, we have a staff of 40 attorneys that's actually what they do is look at these contracts to make sure that there's proper risk transfer, so the organization is not held liable.
Right. I mean, many times what I've seen, especially with not-for-profits that are in their infancy, they're anxious to have volunteers work for them, but then they don't have the volunteer sign any type of waiver, and then the volunteer gets hurt. We saw that immediately after Superstorm Sandy, where a lot of organizations went into homes on the South Shore, Long Island, Brooklyn, and Staten Island to help homeowners fix their homes up, get the muck out, and clean up, and just provide basic services. So they had these many volunteers that were swarming in, everybody doing all the good things, but nobody thought, wait, what happens if somebody gets hurt? Same thing with, clean up.
You just never think about that.
Right. Yeah. Or even clean up the park day. You have all these volunteers that are coming to clean up your local community park. If they get hurt, they're going to look at you and say, wait, you provided me with the rakes and the shovels. I hurt my back. Am I just looking for a payday? So waivers are important to look at. how do we insulate the organization from whether they're a frivolous claim or maybe they are a legitimate claim, but where's the responsibility begin and end?
Yeah, I can say that a lot of organizations that I know of don't necessarily use waivers for their volunteers. So that's kind of an important thing there. Nice. Let's move on to other types of coverages. I know that there are some unique products that you guys offer to the nonprofit sector, things like surrounding unemployment and those types of things. Do you want to touch on that, Ken?
Yeah, that seems to be one of my little my little baby is the unemployment insurance, because it's most not-for-profits or 501c3s that I've come in contact with are not even cognizant of the fact that they have the ability to opt out of the New York State pool system and either self-insure for their unemployment insurance or buy a private insurance product. New York State typically takes in $2 for every $1 in claims that they pay out on unemployment insurance. And when you're in the pool, it's exactly that. You're sometimes subjected to the losses of another organization that, you're all thrown in one big pot, as opposed to having your own separate unemployment insurance policy that is based upon your experience. And typically, last year alone, the average savings for our not-for-profit clients was about $38,000, and the average percent of savings was between 40 and 50% off of their unemployment insurance cost.
That's sizable.
It's sizable. I always liken it to, it's not often where they have a donor coming in and writing a check for $35,000, and that's in effect what we can do. And this is an area of coverage that they're not even aware that they have that option. So I come across a lot. It almost sounds too good to be true. But we work with a company called UC Assure. They're an A-rated carrier. They've insured thousands of nonprofits. Our retention rate is about 99%. We guarantee the rates for 2 years. So the rate is locked in. The way it works is New York State, since we're in New York, we'll just talk about New York State. New York State has a rule: you have to opt out of the New York State pool by 12/31. If you don't opt out of the state pool by 12/31, you're locked in until the following year. New Jersey, just for edification purposes, is 2/1. I don't know why it's not the same, but
Jersey always is.
Jersey's a little bit different. You also can't make a left turn in New Jersey. So, but it's an important thing that we usually do right now in this fourth quarter. We do a lot of quoting for this unemployment insurance, because it's usually found money and they're not even aware that they have the option to do it.
That's kind of cool. What about things like workers' compensation? We constantly see a lot of our clients are overpaying on their workers' comp because no one's really looking at it. It's not an area that people review on a regular basis. What can they do there?
So the most important thing you can do with the workers' compensation is to make sure your employees are classified correctly. So for the most part, when I think of most of our not-for-profits, you're going to have executive officers and most likely just clerical staff.
Mm-hmm.
But at times, you may also see that a carrier will misrate and put a higher class code on. So, part of a good broker's responsibility is to verify the classifications that are on the policy to make sure they match up with what the organization is actually doing. And obviously, if you get outside of just an office exposure, then there are going to be other classifications on the policy. Whether it's if you're in education, there's a classification for teachers. There's all different types of class codes. So it's important that that you do look at how are my employees being classified, and even if there are multiple class codes on the policy, mistakes are made. Do you have people that are truly clerical in nature, which is a very innocuous class code, meaning that it's a very low rate, misclassified in a higher class code? So part of a broker's due diligence is to make sure on an annual basis that these classifications do match up to where the actual employee, the responsibilities that the employee has.
Okay. It's also important to make sure that the organization has an employee manual, and they have something that addresses workers' comp and a return to work policy. Somebody maybe got hurt and they're no longer able to do one specific function, but they can still come to the office and perform, data entry or something that. So it's important to have an employee manual that addresses these items, so it does get the employee back to work sooner rather than later. The other thing is making sure that what I talked about at the opening is making sure that the claims on the workers' comp are, that's one of the biggest bugaboos with me is, that's where a lot of the insurance companies, if you have a workers' comp claim, now you gotta remember you're dealing with New York State. Somebody, like John was talking about, somebody gets hurt, during Superstorm Sandy cleanup, and they step on a nail, and they have to go to the ER and get a tetanus shot. Now, the workers' comp board will set up a reserve on that claim of $50,000. Now, the claim, the gentleman went to the emergency room, he got paid, and the medical bills were paid. It's a $500 expense, but yet the workers' comp board will leave that claim open and put a reserve on there. That reserve will affect the nonprofit's experience modification, because that is going to be held against them when they review the policy for the next renewal. They're going to look at the experience mod, and they're going to see that your experience went from an even mod of 1.00, now your mod is 1.25, which means you're paying 25% higher than your counterpart in the same rating classification. So it's important to make sure that you have somebody who's looking after these claims and making sure that these claims are moved to closure. That somebody's looking at the claim, well, this claim happened 2 years ago, and it was with Ken Cerini. He hurt his foot, and now he went back to work the next day. We don't need that reserve set up there for $25,000 or $50,000. They pick up the phone, take it off, and now that comes off their loss experience. If nobody's doing that, the experience mod just going to keep going up and up and up, because the insurance companies, unfortunately for us, the reserves are backed out of their profit. So it behooves them to have very large reserves, because that backs out of their top line. Okay. If they have a large reserve.
What other insurances do you want to talk about before we move on to a different topic?
Just the one last comment on workers' compensation. The other important thing for not-for-profits to look at is to make sure volunteers are covered under, and it's a separate endorsement, talking about constructing policies earlier. So under a workers' compensation policy, as the name implies, it's to cover your employees or your workers, but it should also be extended to your volunteers, so that if they are hurt, at a minimum you have a backstop of an insurance policy if it's proven that you're responsible for that.
Cool. So let's kind of switch gears a little bit. So we've talked about the different types of coverages that exist out there, but what can a nonprofit organization do to help potentially reduce risk, and thus, if you reduce risk, reduce premiums? So are there things, good practices that nonprofit organizations can put in place that will make them more favorable from an insurance carrier perspective, and maybe then reduce their premiums?
Well, one of the things that I mentioned is having an employee manual, a safety manual. Carriers look at that. They want to see that you're addressing employee safety and employee practices. If they're using a organization's vehicle, that there's a cell phone policy, that there's that they're not texting while driving and things like that. So having an employee manual or rules and regulations in place will certainly aid us when we go to the carrier, so we can present that to the underwriter and show them that they have proper safety procedures in place.
Does that really help? And does that really help bring the premiums down? Does that really give you the leverage you need to argue the rates?
It certainly gives us a leg to stand on. Yes, absolutely.
It helps differentiate the client from, if there are three not-for-profits that are sitting on an underwriter's desk and they look at one and they realize this organization has proper risk transfer in their contracts. They do have a safety manual. They're cognizant of risk, versus somebody else is like, well, who's going to sue me? I'm a not-for-profit. So it puts you in a more favorable light with the underwriters as they start to evaluate risks that they want to go on.
Okay.
I think also what's important is that what we see is that there's somewhat of a misnomer out there that as a not-for-profit, I don't have to worry about many of the things that Ken was just talking about, but we really look at it that a not-for-profit and a for-profit privately owned firm have many of the same risks, but a not-for-profit may not necessarily have the infrastructure that a for-profit organization has to mitigate those risks. And that's really where your broker should be helping you, looking at the contracts, looking at your lease to make sure, your landlord wants you to maintain an exorbitant amount of insurance. Is it really necessary? We would suggest you go back and push back and say, do I really need a $10 million umbrella? I'm renting 1,000 square feet. Whatever the issues are, just to point out ways that can help reduce their cost of insurance to bring down their annual expenditures where appropriate.
Yeah, I think the other place where nonprofits are different, there's a lot more outside interaction in the nonprofit world, because nonprofits are pretty much all labor. So there's a lot more interfacing with the outside environment and a lot more decision making happening at lower levels in the nonprofit sector, which all then adds to the risk.
Correct.
So we're kind of running out of time, but a couple of other questions. Can you maybe just, for the people listening in, talk a little bit about what's the difference between, because you hear of these claims-made policies and occurrence-based policies. Maybe just talk a little bit about what's the difference between the claims-made and occurrence-based policies, and why one is maybe better than the other or different from the other.
Well, yeah. You want to address that?
Sure. So there are some policies that are always written on a claims-made basis, and directors and officers liability would be one of those examples. A claims-made policy, as the name implies, covers you for claims that are made during the policy period. So if your policy runs annually from January 1 to 12/31, and you have a claims-made policy, if a claim is made during that policy period, if that policy would respond. When your policy renews the following year, you now have a claim that is made in this, let's bring us to December. So in January of 2020, a claim is made for an act that actually occurred in November of 19. If your policy is written properly, although the claim is made in the 20 policy period for an event that happened in 19, the 20 policy would respond. But it's important that your broker make sure that they wrote the policy properly, that it picks up the prior act, because the actual act occurred in 19. Right. An occurrence policy, which is always the preferred method, but again, as I said, you don't see it in a D&O policy, but a general liability policy you always want it written on an occurrence basis, because what that basically means is, if I had a policy in force for year 2019, and 2 years later a claim comes up that somebody tripped and fell on my sidewalk in front of my office, even though it's 2 years later and you've changed carriers or you're no longer in business, as long as you had a policy in force on the date of the loss, not the date it was reported, but the date the actual incident happened, the occurrence policy that was in force at that time would respond, regardless if regardless if you're not with that insurance company or the carrier, or you no longer have insurance.
Right. Occurrence is always the best policy. It's always the best way to go, because basically it's forever coverage.
Right.
As long as there's proper notification, claims occurrence basis is always the best way. We're seeing more and more carriers, they will only write EPLI coverage or sexual assault and molestation coverage on a claims made basis, because that's where they're seeing most of the claims. So that's where they don't want to have an extended tail. They're going to have a defined coverage period.
It's also something that nonprofits have to be aware of, the two different types, because when they get a price quote, if one's quoting on an occurrence basis and one's quoting on a claims made basis, the occurrence basis might be a little more expensive, but it might be worth the added cost.
Correct.
Correct.
Correct. So we're kind of running out of time. We've got like a minute or two left. So if you guys want to maybe just throw out one or two takeaways that people should kind of think about in terms of when they're dealing with insurance.
Well, I'll just piggyback off of John's comment, as far as, and he made a very good point. I mean, nonprofits are not really subjected to the same external scrutinies as their for-profit counterparts. So when they're in that kind of environment, usually there's a sense of complacency. You don't have external boards or external that are watching every move that you make. And I think it's important to make sure, and for that part, for directors and officers, it's usually a part-time gig for an officer of a nonprofit. They're doing it because of the love of the organization. So they don't really have the time, they have a full-time job. They don't really have the time to make sure that, proper things are in place to make sure that they're going to be covered. So that's why it's important to make sure that the organization is working with a true risk manager that is making sure that
everything's taken care of.
Everybody's back is covered.
And I would just echo Ken's sentiments. I think most boards, given the higher scrutiny that many are facing these days, many organizations are facing these days, is look to board members that can bring accretive value to the organization. Do you have somebody there that has a legal background, somebody that has a finance background, somebody that has a true passion for the organization itself is always great, but are they bringing you the level of expertise that you need as an organization to ensure, no pun intended, to ensure that that the organization stays true to its mission?
Okay. Ken, if a nonprofit organization wanted to reach out to you guys over at Sterling, how would they go about doing that?
I'm always available. My email address is kjones@sterlingrisk.com. And my direct line is area code 516-417-5118. And I always put my cell phone out there because it's always good to let everybody know that I'm available 24/7. My cell phone is 516-353-4197.
So at 3:30 this morning when I call you, you'll be okay with that?
You know what, Ken? That's always my question. One of my questions when I meet a client for the first time is that 4 a.m. question. Do you have a broker that you're working with right now that listen, another name for the insurance business is stuff happens. And stuff always happens. It doesn't happen at 11 o'clock in the afternoon or in the morning. It always happens at 3 o'clock in the morning. And do you have the relationship with your current broker? So if something happens at 4 a.m., do you have his number where you can call him and get an answer?
Good job. So Ken and John, I want to thank you for your time today. And thank you everybody for listening in. Tune in on October 17th at noon when our guests will be John Appelt and John Coyne from Prime Auditors. We'll discuss ways that organizations can reduce their costs through auditing their bills. Until then, keep making a difference. One other thing before we head off, on November 20th, we're going to be doing a board training at Capital One over in Melville. So if anybody's interested, please reach out and sign up for that. Thanks again for tuning in.